September the 15th, 2008, on a Monday morning in New York City, employees of 158-year-old investment banks are walking out of a Manhattan skyscraper carrying cardboard boxes. Now, photographers are waiting on them on the pavement. And by lunchtime, these photographers are on the very front page of every single newspaper on planet Earth. The bank is called Lehman Brothers, and it's just filed for the largest bankruptcy in America's entire political history. And now, within a year, the world will have lost around $10 million in wealth. Tens of millions of people will lose their jobs, and families will lose their homes in numbers not seen in decades since the Great Depression. And almost none of them will have any idea why this is actually happening. This is the story of the 2008 financial crash. And so throughout the early 2000 years, house prices in America were steadily rising, and it felt like they always would do. Buying a house wasn't just about having somewhere to live anymore. It was really an investment, a guaranteed investment at that. And banks begin to notice this trend too. They notice something else. If house prices only go up, then lending money to buy a house is basically just risk-free. And even if the borrower can't pay you back, then you just repossess the house and sell it for more than you lent. It was an obvious and great tactic by the banks. So the banks stopped asking hard questions. Loans went out to people with poor credits, unstable incomes, and sometimes no proof of income at all. Inside the industry, they had a nickname for these: ninja loans. No income, no job, and no physical or digital assets. Nobody really seemed to mind because the banks had found a decent way to make their risk completely disappear. But here's where things get really clever, and here's where it also gets pretty dangerous. Banks didn't just hold on to these risky mortgages. They actually bundled thousands of them together in a single financial product and sold slices of that bundle to investors all over the world. Now, these bundles had a name: collateralized debt obligations, or CDOs, and the idea was that even if some of the mortgages inside the bundle went bad, most of them wouldn't. So the bundle as a whole was safe. Credit to the rating agencies, the very organizations whose job it was to warn investors about risk. They simply stamped these bundles with AAA ratings, the safest rating there is, the same rating given to the US government. And so pension funds brought them, insurance companies brought them, banks in Germany, in Iceland, in Scotland bought them. A crumbling loan given to someone in Ohio who couldn't afford it was now sitting quietly inside a retirement fund in Norway, and nobody involved even knew it was happening. And then, layered on top of all of this, came something even stranger: credit default swaps, essentially insurance policies that paid out if a bundle of mortgages failed, except you didn't need to actually own the mortgages to buy one. You could just bet that they'd fail. Now, one company in particular sold these swaps by the trillion: an insurance giant called AIG. They were in effect promising to cover catastrophic losses across the entire financial ecosystem without setting aside anywhere near enough money to actually do it if the bet went wrong. Absolutely nobody was checking, nobody was regulating anything properly, and almost everybody from the traders on Wall Street to the regulators in Washington genuinely believed that house prices simply could not fall anywhere at once. And well, let's be honest, they were completely wrong. In 2007, the crack started to show. House prices started climbing, and then they started to fall. Borrowers who could only ever afford their mortgage if prices kept rising started defaulting in their thousands, then in their hundreds of thousands. Now, suddenly those AAA rated bundles weren't safe at all. Nobody knew what they were really worth, and nobody wanted to buy them. And because nobody knew which banks were holding the bad ones, banks stopped trusting each other completely. And so then in March of 2008, Bear Stearns, one of the giants of Wall Street, nearly collapsed in days. It was sold off in a hurried government brokered deal for a fraction of what it had been worth a year prior. Now, this really should have been the warning that simply saved everything and everyone, but instead it was really just the beginning of a catastrophic downfall. By September of 2008, the US government had already been forced to take over Fannie Mae and Freddie Mac, the two giant firms that backed almost half of all of the American mortgages. The system was now officially buckling. And then came Lehman Brothers. Over one frantic weekend, officials at the US Treasury and the Federal Reserve tried to broker a rescue deal. Other banks were approached, and none would take Lehman on. And this time, unlike with Bear Stearns months earlier, the government decided not to step in with public funded money. So on the following Monday morning, Lehman Brothers filed for bankruptcy. 158 years of history gone in a simple weekend. The reaction was immediate and violent. Global stock markets went into free fall. Credit markets, the lifeblood that lets ordinary businesses borrow money to pay staff and buy stocks, simply all froze completely solid. And AIG, the insurance giant that had promised to cover losses across the entire system, was suddenly facing demands that it could never pay. Within a day, the same government that had let Lehman fail agreed to pump $85 billion into AIG to stop it collapsing. And it too was interconnected. Too dangerous to let go. So the world had just now learned that it was an uncomfortable truth, and some institutions were considered too big to fail. Others apparently, though, were not too big to fail. And so within weeks, the US Congress asked to approve a $700 billion loan to prop up the banking system, and it was called the Troubled Asset Relief Program, or TARP for short. It was deeply, bitterly unpopular, not just by government, by standard Americans. Ordinary Americans were now losing their homes, their jobs, their savings, all whilst watching the very banks that caused this exact crisis get rescued with their public money. To many, this felt like the people responsible were being protected, and the people who'd done nothing wrong were the ones being left to suffer the consequences completely and utterly alone. And the numbers really back up that anger, because before it was over, the crisis wiped out close to 9 million American jobs. Millions of families were foreclosed on their loss of their homes. Stock markets across the globe lost trillions of dollars in value. Iceland's entire banking system collapsed, and countries across the EU were pulling into years of recession that followed. It wasn't just an economic event, it reshaped politics for a decade, and it fed movements like Occupy Wall Street, and it fueled a deep lasting distrust of banks, governments, and institutions in general globally. A distrust that in many ways is still shaping our politics around the world today. And so in the very years that followed, new laws were passed to try and stop this from ever happening again. Banks were forced to hold more capital in their reserves, and regulators were given power to watch for risks that had gone unchecked for so long. But perhaps the most striking thing about the 2008 financial crash isn't the engineering of it, or the trillions of dollars, or the collapse of the Lehman Brothers itself. It really is how the ordinary mistake was at its core. People believing prices would keep rising forever. They stopped asking the hard questions because everyone else had stopped asking them too. And when the illusion finally broke, it wasn't the people who built the system who paid the highest price. It was just the ordinary, everyday person. Well, that's the story of the 2008 financial crash. I do hope you enjoyed the video, and make sure you do follow me for more videos soon. Thank you for watching.